You're a buyer, I get in now and I wouldn't worry about interest rates.
Welcome back to another episode of Change in the Market. I'm your host today, Kevin Chamala, here with real estate expert Chris Masiello. Thank you for joining us today.
Hey, Kevin, good to be with you. Good to be with everybody in our community.
Absolutely. So we've read and heard some interesting things about the increases and decreases in home prices across different metro areas. So what type of strategy would you employ as a seller or buyer?
Well, I think we talked about this last week. Let's start with the seller first. I think from a pricing perspective, there's, like we were talking about last week, there's different parts of the country that have done better than others, with post-pandemic population dispersal, right? So, there are parts of the country that did well, like the Northeast, upper part of the Midwest, when you get into like Chicago, Michigan, Wisconsin, places like that. And then certainly down to Colorado, down into Texas and Florida, have done, those states have really done pretty well. And so I think you always have to be careful about your regional pricing, right? So you might hear that sales prices are up 5%, but you got to drill that down locally. So you have to talk to your local professional about, okay, well, what's going on in my market? And then even my neighborhood. That said, I think you really got to be careful about pricing. Inflation has come down, which in a lot of ways actually helps affordability, right? Because you have more disposable income, although interest rates have gone up. So we got these two, this correlation between interest rates and inflation. They kind of flirt with each other. They haven't totally neutralized each other, but a little bit. Inflation going down, your cost of goods that you're buying has gone down, even though interest rates have gone up. So there's some equalization there from an affordability perspective if you're a buyer. But as a seller, I think you got to really be tight on your pricing. And like we were talking about last week, you have to calibrate your pricing not only to the market, but you have to calibrate pricing to what your time frame is. Like, when do I want to leave here? You might have to be more competitive in the market if you want a faster sale. If maybe a little bit longer wait fits into your plan, well, then maybe you can be slightly more aggressive, but you can't be hugely over aggressive.
No, absolutely. And then what would be a good strategy for the buyers then?
If you're a buyer, I get in now and I wouldn't worry about interest rates. I know that probably seems like a really bold, maybe even a cavalier statement, given the fact that, rates have doubled in the last year. However, prices are still appreciating, but they're not appreciating. Again, this is nationally. It could be different locally, at a fairly modest rate, 5%-ish, again, national level. And when there becomes more inventory, or as interest rates start to go down, prices are going to go back up again at a much faster pace. Might be 10%, might be 15%. You could have some markets that are 20%. And so if you're a buyer, the strategy would be to get in now. Get in now because you're buying at the right price. Mortgages in this day and age are kind of disposable. If you don't like the one you got, you can get another one.
Absolutely.
Right.
Absolutely.
And this kind of like, cruel twist of fate, mortgage companies actually like giving mortgages because that's how they make their money. So if you want another mortgage, you can get one. Right?
Yep, absolutely. Yeah, we all know how they make their money. And I think one of the key words there that you had mentioned as well is inventory. We know we most likely won't be getting a lot of inventory from new builds and home construction. So how will some of that inventory be alleviated? Would that be investors offloading? Would that be commercial real estate?
Yeah, rents are, that's a really good question. Rents are slowing down, like the rise in rents, has slowed down. And so the return, it's still good, but it won't be as good as what investors are looking for. So I think you're going to see some investor units re-enter the market just by the nature of the fact that it's time to offload them. So I think that will add some inventory. The other thing, which again it happens nationally, but it might not happen locally. It depends where you are, right? Is that you're seeing the repurposing of a lot of commercial buildings into apartments and maybe even condominiums. So, in the cities, of course, it would be high rises, but, in more rural areas, it could be a shopping mall, or some other, other office type building that's going to get repurposed. There's still demand for commercial space, but there's not as much as there used to be, just because people are gotten used to at some level working from home. Businesses have gotten used to, having, key employees, right? Key members of the team working someplace else, just like you and I did. So a lot of that space is going to get repurposed. And you're seeing that now. And I think that's going to add a lot more housing units, both on the rental side and probably on the condominium side. And just one last thing on that too, is that foreclosures or distress sales are only 2% of the market. Now, if you're one of those foreclosures, of course, that's an impactful moment for you personally, but generally speaking, that is not something that we're going to see to replenish the market, the stock currently for sale.
Might be a little curveball here, but speaking about housing affordability and how that plays into the market, right? I think I recently read and saw that 27% is the amount that people are using of their income towards their mortgage. Mortgages are up to $2,000, which I think is a 2 or 3% increase compared to the year before. How is that impacting the market, if at all? What does that mean for either buyers or sellers, I guess, based on those statistics?
Yeah, the 27% of your disposable income is a pretty normal number that's been around for a while. It could be as high as 35, depends, on your personal situation. It depends on your credit, really. And like we were talking about, right? Other costs of your household have gone down, right, with inflation. And so there's a little bit of an offset there. And again, what you really got to take a look at from an affordability perspective is the house I'm buying today. This is when it's going to be the most affordable. Now, rates are going to go down. Rates go down, prices are going to go up. Now you're going to have a better rate, but you're going to have, at some level, a higher sales price, and that sales price is fixed, but the rate is not. And so I think from an affordability perspective, that's really, to me, a very compelling reason to get in now.
No, absolutely, and that it ties into, I think, what we just talked about like, don't worry about interest rates, right? So I think it all ties in together, and I think that's a great way to close out this episode and go over some of our key takeaways, right? And
yeah, one takeaway, that I'd like to share with everybody is, I think opportunity is pretty amazing. Like, if you take a look at the fact that commercial, office buildings are being repurposed for residential housing, I just kind of marvel at that. Now, granted, like, it doesn't seem like it's like huge thinking, right? But it's like opportunity tends to really hide in plain sight, right? Like, where's the best place to hide something? It's in plain sight. And so the other thing about it is, like, I have this theory about, if everybody's running over here, all the opportunity is being absorbed over here. Where's the best place to find the opportunity? Where everybody is not.
Right.
And so you have to kind of really look for that opportunity. I think today's housing market is that way, right?
Yeah.
Is that when people are like when people are over here saying, well, rates are going up, I'm not going to buy just yet, even though they might be able to afford to, or I'm not going to trade in my older house for a bigger house, whatever the case may be. I'm just going to stand still. Well, that's where I wouldn't see a lot of people. That's where the bulk of people are, right? The opportunity then is to go do just the opposite.
Of course, absolutely. Right. I think that's a great way to close it out. I think we had a great episode today. Thanks again, Chris, for taking the time today to speak to us about the market. I'm your host, Kevin Shamala. We'll see you next week for another episode of Change in the Market.
Bye, folks. Thanks, Kevin. Appreciate it.